Having said that, there's no rule which says that equities crash when we go into recession. That's far from the case historically. So I keep a very open mind, and just because the indicators are pointing down at the moment, I believe there's always the possibility that they'll turn around the indicators and the stock market could go up without warning. So you have to be prepared as an investor for all scenarios. And what does that mean? It means be diversified by asset class. Don't have all your eggs in equities. Don't have all your eggs in gold. Don't have all your eggs in Bitcoin. I know there's plenty of people who are maximalists and they want to have everything in one thing. And of course, we have our cash maximalists who think that the way to play the game is to be 100% in cash, waiting for this crash. And when crash comes along, they believe that they're going to dive in right at the bottom and make a killing when everybody else is panic selling. I can tell you that's unlikely to happen, i.e. people diving in at the bottom, because throughout my career, I've seen people sometimes selling ahead of a crash which never came, but on rare occasions selling before ahead of a crash. And
Sometimes the math stops adding up in every commodity cycle. Silver sits on that fault line now. Most experts overlook Clive Thompson's first figure. The global investment demand for 200 million ounces of silver is expected this year. Dividing that by the global population yields shocking results. One person in 45 can obtain an ounce. That assumes no demand increase. However, demand is soaring, and half the world can't afford anything. That imbalance alone makes silver more than a metal. Scarcity is emerging. If the 200 million ounce prediction develops into 400 million ounces, which is possible if investors in Asia, the Middle East, and the West accelerate their allocations, the supply deficit becomes a disaster, grades decreasing, permitting delays lengthening, and capital investment lagging for over a decade make mine supplies unscalable. Only recycled silver remains. The only way recycling increases is how Clive frames it. Tomorrow's price must rise. Silver may look inexpensive, but it's already acting like a supply-strapped asset. Gold signals a sovereign shift. The world's most aggressive gold buyers are central banks, which stealthily accumulate gold. Some, especially China, buy without reporting. China's official reserves have curiously plateaued since 2014. Despite producing 20% of the world's gold and growing its trade surplus, divergence indicates concealed accumulation. Adding the constant supply of 400-ounce bars from Switzerland and the UK into Chinese vaults makes the picture clear. Gold, not dollars, is being used by the world's largest players to realign money. Western retail investors are nearly completely uninvolved. ETF outflows, despite gold's record highs, tell a remarkable story. Retail is selling while sovereign and institutional purchasers are accumulating record amounts. Every great gold bull market ended once the masses bought, and we're nowhere near that position today. Early on, quiet money positions itself before widespread attention. The next piece of Clive's analysis follows. The role of central banks. Mystery purchasers maintaining gold at record highs. And the structural lag in the global banking system explain why the major rise hasn't happened yet. Enable alerts, subscribe, and like this video before continuing. This deep dive analysis is for data-driven viewers, not conventional sound bites. If you like this article, please support it.
And I've been investing money for 50-odd years. People are talking about an imminent crash. And we have seen equities down, and they're down again today. I think we're probably off about 5% from the peaks, maybe a little bit more. That's not a crash yet, but the warning signals are, the indicators are all flashing sell. So it could go lower. And there's a lot of reasons to expect that this time might be the let's say, a decline or the crash. The first one is that the unemployment numbers continue to climb in the United States, and that's indicative of a slowing economy. We've had these tariffs which are eating into inflation, which means people will spend less. I mean, they're spending more, they're spending. They don't have more money, so they're spending the same amount of money, but they're getting less goods for the same money because it's costs a little bit more, and that means the total consumption goes down a bit as well. So As far as the economy is concerned, I'm not terribly positive that we'll have a boom. I'm more thinking that it'll be a bit of a slowdown. Having said that, there's no rule which says that equities crash when we go into recession. That's far from the case historically. So I keep a very open mind, and just because the indicators are pointing down at the moment, I believe there's always the possibility that they'll turn around the indicators and the stock market could go up without warning. So you have to be prepared as an investor for all scenarios. And what does that mean? It means be diversified by asset class. Don't have all your eggs in equities. Don't have all your eggs in gold. Don't have all your eggs in Bitcoin. I know there's plenty of people who are maximalists and they want to have everything in one thing. And of course, we have our cash maximalists who think that the way to play the game is to be 100% in cash, waiting for this crash. And when crash comes along, they believe that they're going to dive in right at the bottom and make a killing when everybody else is panic selling. I can tell you that's unlikely to happen, i.e. people diving in at the bottom, because throughout my career, I've seen people sometimes selling ahead of a crash which never came, but on rare occasions selling before ahead of a crash. And they sit there through the crash, watching it go lower. And the lower it goes, the more it vindicates their opinion that things are bad. And right at the bottom, they feel maximum bearishness. In other words, they believe it will continue much lower, because bearishness is always higher at the bottom than it is halfway down. So they're feeling maximum bearish. So they cannot, and mentally they cannot buy back in. So I've seen people who've probably been in cash now for 30 odd years after selling out before what they thought was going to be a crash. And I've also seen people who sold out in the most recent crash, being the COVID pandemic. Was that 21 or 22? I forget now. But in March 21 and 22, when COVID started, we had this massive swing down. It lasted a couple of days, and there were people who sold into that, and to my knowledge, have not bought back. Now, I'm not saying they sold everything, but there were people who went from something like 70% equities down to 20 or 30, and now they're waiting for the old price to come back again, the low of the pandemic, which it won't come back easily, to justify that they were right. There are certain similarities but compared with the late 1990s, and there are certain differences. Let's just start with a fundamental premise. Just because things are overvalued or undervalued does not mean they revert to the fair value. There's an assumption that they should, and everybody thinks, we all think in waves. If it's overvalued, it's got to go down. If it's undervalued, it's got to go up. But that's far from mathematically proven. The most classical example of that is if we go back to 1996, when Alan Greenspan said irrational exuberance, because stocks were massively overvalued in 1996. So he thought, and so the market thought, and the Wall Street Journal and other reputable journals thought stocks were overvalued, and therefore they had to come back down. But people just kept buying and buying and buying, and we had another 3.5 or 4 years of a bull market, and you'd have missed out on the next 200% of upside had you said, oh my God, someone who knows what they're talking about, Alan Greenspan, says they're overvalued, I'll sell out. And now, when the crash came, it was largely focused on one sector, the very overpriced technology and what we called at the time the dot-com sector. Those were the days when if a company came out and added .com to the end of its domain name, to the end of its name, you could rapidly see the price rise a lot. And there was a time before that, even long before that, in the early 90s, when if a company simply got an email address, sales at whatever, simply getting an email address showed they were ahead of the technological crowd, and you would see the share price rise on the back of getting an email address. Well, where are we today? Well, all a company has to do is mention the word artificial intelligence. In other words, we're buying it, we're using it, we're making it, whatever, and suddenly the share price will go up. And that comes down to what you said about liquidity. There's a huge amount of liquidity in the world looking for a home. It's sitting on the sidelines. I mean, we only have to look at Berkshire Hathaway. They've got $350-something billion sitting on the sidelines. They started raising that cash in 2022. That's 3.5 years ago. By the end of 2022, they had a lot of cash on their balance sheet, and it's only gone up since then. So, to illustrate that, Berkshire Hathaway have just bought in this week. Yesterday, I think it was announced, or maybe over the weekend, they announced they're buying $4.9 billion, or had bought $4.9 billion of Alphabet. That Alphabet are the makers of Google and YouTube. Now, the price they paid now for that is probably 2 or 3 times the price they could have paid for exactly the same number of shares of the same company had they bought it when they first started raising cash back in 2022. So what's happening? They've got this huge cash hoard, and they're getting twitchy fingers. And Warren Buffett is a smart cookie, so I think he's done a great thing buying Alphabet. Alphabet is relatively. I'm not making an investment advice here, but Alphabet is not bad value at today's price. It was just better value at a third of the price. But we're seeing more and more people gravitating towards YouTube, for example. But on the negative side, people are gravitating away from Google. They're going to the AI tools. Now we've got plenty of these AIs like Perplexity have got Comet, and ChatGPT's just bought in a browser as well. I forget the name of ChatGPT's one. But these browsers are now starting to take the place of Google because they give you better results. Of course, I'm sure Google has either got its new AI browser, or if it hasn't, it's coming very quickly. So there's positives and negatives about Apple, not Apple, about Alphabet. But, Warren Buffett has been sitting on this cash for years and years. I mean, Berkshire Hathaway, of course, Warren Buffett being in charge until the end of this year. And finally, can't wait any longer. We've got to do something with this cash. And I think that's representative of the whole world. There's armies of investment managers who are sitting on a lot of cash. They've done that because they felt bearish since 2022 or whatever. They maybe took the cue from Warren Buffett. He's selling, let's sell a bit as well, raise some cash. And there comes a point where you can't sit on it any longer because your investors are saying, what are you guys doing? Am I paying you to do nothing? Or am I paying you to invest my money? If you're doing nothing, I could invest my own money. I could put it in a money market fund and do it myself. Why are you doing it for me and charging a fee?
Clive's analysis of central bank gold demand reveals a major shift the West has failed to acknowledge. According to World Gold Council surveys, 75% of central banks expect to expand their gold holdings in the next years. This purchase reporting is fragmentary, late, or purposefully hidden. The disappearance of Western 400 ounce bars, flat Chinese official reserve levels, and rising gold prices notwithstanding ETF outflows make the conclusion inevitable. Buyers driving this bull market are not retail traders. Governments, institutions, and massive unknown entities are preparing for post-all. Clive makes a crucial point about Western banks. They scarcely participate. Even institutions that promote gold rarely have customer portfolio gold exposure. Legal compliance, product structuring, client limits, and internal risk committees make the trip from 0% to 2% to 2% a bureaucratic nightmare. The large-scale institutional money hasn't moved yet, since that process takes years. When it happens, gold mining, which NVIDIA might acquire 4 times, could encounter flows that reprick the industry.
We have a bit of, we've had a bit of a data blackout, but all the signs point to the economy being slower than it has been. And we've seen these adjustments to the labor statistics where it turns out for a couple of years, the number of new jobs which were being reported were massively overreported. I mean, very significantly. I called that out, and there were others who called it out by simply looking at the household statistics. So when the Labour Department, the Bureau of Labour Statistics, brings out their numbers, there's 2 numbers. One is called the non-farm payrolls number, which is the one which the whole world watches and judges how strong the economy is. And the other one, which is brought out on the same day, at the same time, by the same agency, is called the Household Survey, which is a survey of one is measuring how many people are working, or how many jobs there are, rather, and the other one is measuring how many people are working. And these 2 surveys have been pointing in different directions. The non-farm payrolls survey has been showing that there's more and more jobs, and the household survey has been showing effectively that there are less and less jobs. Why? What's the difference? Well, the difference is lots of people are losing their jobs, but those who've got jobs are now having to work 2 or 3 jobs, hence the non-farm payrolls number goes up because there's more jobs, because they're working 2 jobs to keep their head above water. Whereas more and more people are saying, I give up. I'm not going to try anymore. So in that respect, we've got a smaller population working, and those who are working are, to a large extent, working harder than they were ever before to keep their head above the water. So you've got those who are saying, I'm going to fight, I'm going to defend myself by working, and those who are saying, give up, hand me my benefits, please. And I think that for me is indicative that we're heading into a recession. Of course, the other thing we've got coming, and coming with a vengeance, is artificial intelligence. That is going to put hundreds of millions of people around the world out of work. Let's face it, if you have AI and someone in your office can use it, it's going to make that person many times more productive if he knows how to use it well. And AI, from the firm owner's point of view, it doesn't need a desk, it doesn't need a cubicle, it doesn't go to the bathroom, taking its telephone with it, it doesn't stand by the coffee machine discussing last night's Netflix, it doesn't ask for pay rises, it doesn't upset the girl in number 42 cubicle, it doesn't take holidays, it doesn't have kids, it doesn't go on sick leave. So the case for having AI efficiency in people's offices is extreme. And that means that virtually every IT department in every large firm will be working to implement IT in the offices, in the front office, where the workers are. And the workers will say, oh, this is great because they're making me more efficient. I can do my job much easier. I can say reply to this email or whatever they do. They're going to make all kinds of things will be easier. But what they don't realize is that some of those people at the front office are going to become better than others at mastering the technology and will be able to do the job of 2 or 3 or more people because of that. And that means less people will be needed. And we're already seeing the first waves of layoffs happening due to AI making the jobs for those who could master it that much easier. And there's a lot more going on that we don't actually see in the headlines. I have a friend who works for one of the largest companies in the world. He's at the Swiss office here. It's a company with several 100,000 employees globally. He tells me that their company at the moment are working on 15% across the board layoffs. They're doing it quietly. They're doing it under the radar screen. But the reality for the reason doing it is artificial intelligence. They're not making any public announcements about it. They're just quietly letting people go a bit here, a bit there, with the target of getting rid of 15% of the labor force within a year and a half.
Clive then notes that silver is outperforming gold in this bull market, and it's early. Higher prices may decrease industrial demand, but investment demand dominates. Prices increase rapidly when investment demand dominates. A rush of new buyers revalues a structurally scarce asset quickly, unforgivingly, and typically permanently. Math doesn't lie. 1 ounce puts you ahead of 46 individuals worldwide. Clive is cautiously positive on copper. Electrification, EVs, data centers, and grid expansion drive long-term demand. Economically sensitive copper. He supports the slow accumulation of copper miners over 6 to 12 months. It's a calculated strategy in a market that favors patience over violence. Uranium's demand is solid, but mining shares are pricey, and Clive hasn't found a good entry position since his last deep dive analysis. The erosion of fiat credibility links this. Clive notes that Western countries are increasingly poorer, drowning in debt, and unable to control their money production. The long-term outcome is predetermined when a system can only issue additional liabilities. That's why institutions and nations are quietly buying actual metals to leave the dollar. Gold for financial security, silver for scarcity and asymmetric upside. Copper for industrial demand, uranium for energy security. This is why today's market favors informed contrarians. Tech equities continue to captivate investors. Western ETFs leak gold. Banks have barely started allocation, but central banks, sovereigns, and deep-pocketed buyers are swallowing physical ounces at record rates. The underround, misunderstood, and undervalued metals window will close. The data already suggests that scarcity, institutional repositioning, and a monetary system losing credibility faster than authorities can contain will drive the next bull market phase. Use this breakdown, subscribe, and share this video. It exposes this information to more audiences trying to understand the biggest financial shift in decades. Write in the comments what you want the next deep dive to cover: silver supply, central bank flows, mining stocks, or de-dollarization 2.0. Thanks for watching.